Guys and girls, welcome back to another Bumond Outlooks video, and today we're discussing professional portfolio reviewing. Now, why review your portfolio? Reviewing an FX trading portfolio is a critical process for all traders aiming to optimize on their strategies, manage risk, and improve overall performance. It is simply useless to solely track P&L. Many other factors contribute to professionally reviewing your portfolio, including how to collect the correct data and inputs for an accurate analysis. Without a step-by-step process of how to do this, the majority of retail traders will go throughout their whole trading career without truly knowing what they did correct and incorrectly. Now, step one, define your review objectives. Why are you reviewing? Determine what you aim to achieve with the review. Objectives can include assessing overall profitability, evaluating your performance of specific pairs, or analyzing the effectiveness of your risk management, or identifying overall areas of improvement. P&L, profit and loss, is merely one portion of the review process. As a trader, you must be self-aware, market aware, and bring clear intentions to the table on what your reviewing process is setting out to achieve. Collecting the trading data. Trade history. Gather detailed information on all trades made during the review period. This is the first genuine step you're taking towards understanding your outcome. Now, this includes entry and exit points, trade sizes, currency pairs traded, profit or loss for each trade, and any commissions or fees paid, because of course that is heavily overlooked. Swaps included here because swaps is a big factor that can lead to even more profitability or a lot of cost. Now, the market conditions. You need to compile data on relevant market conditions during the period of your trades. Will we risk on? Will we risk off? Was there major economic announcements? Was there interest rate changes? And, was there any geopolitical events that may have impacted currencies? Day-to-day inputs include, and should include anyway, to accurately conduct your research, the conditions about yourself. For example, sleep hygiene, relationships, nutrition, water intake, any factors that can enhance or hinder your performance, anything that can affect you. You should know your day-to-day inputs and what is affecting your thought processes. Now, step 3, analyzing performance. First of all, of course, profitability. Calculate the total P&L for the period, as well as the profitability of individual trades or pairs. You may see a pattern emerge. Risk analysis. Review the risks taken on each trade and the overall portfolio. Assess metrics such as drawdown, leverage used, and the risk-to-reward ratio of successful versus unsuccessful trades. Now, this is a very key one, your strategy effectiveness. Evaluate the performance of your trading strategies in different market conditions. Identifies which strategies worked well and which did not, considering the context of the market behavior and the time of each trade. For example, were you waiting for a break of structure prior to news hitting? Or were you looking to trade news so you positioned too early? Or did you get caught trading that news? Understanding your effectiveness of your strategy and the market you're trading in is vital. Now, assess risk management. Very basic, but it needs assessing. Examine how effective you managed risk across your portfolio. Look at the use of stop-loss orders, position sizing, diversification. How effective were you at mitigating all risks to your account balance? Now, looking at your adjustments, you need to identify any instances where better risk management could have minimized losses or protected profits, and run the same exact example on all of your trades and exercise on all of the previous positions. Step 5, benchmark against market performance. Now, this is where the professionality comes into it, and the professionalism, I should say. Compare your portfolio's performance against relevant benchmarks, such as the performance of major currency indices or the returns of other traders in funds similar to you or similar markets. A very common benchmark is, did you or did you not beat the S&P's average return over the last 10 years? That's a very common one. Now, you have to contextualize this as well. You have to consider the impact of market conditions on your portfolio and understand whether the results you achieved were overly optimistic to average out over the next 10 years, or maybe you underperformed due to the volatility. But understanding whether your results were achieved in a particular volatile or calm market period can produce insights into how robust your strategy is in different market conditions. Step 6, where are we going to improve? Now, implementation is the key here. You have to apply the changes that you have identified in your action plan. You have to monitor how these changes are then, of course, developing into your returns through regularly reviewing your portfolio and implementing the changes and effectiveness to make further adjustments. You need to journal these results and maintain the detailed trading journal to facilitate easier and more accurate portfolio review in the future. You can use software to automate some of the aspects of this, such as performance metrics and calculations. But ultimately, if you follow these steps and you systematically review your FX portfolio objectively, you can gain valuable insights into your trading performance, refine your strat, and enhance your ability to achieve long-term success in this market. Now, that's professional portfolio reviewing. It's something we should all be doing, and we don't stop doing until we retire. Hope you enjoyed this video. I'll catch you in the next one.